Coach Julien here. So you're thinking about selling some investments. The market is high. There's maybe a bubble. You made money and you want to realize some profits. In this video, I'm going to explain to you how and when you should sell your investments. So stay tuned. Hi, I'm Julien Regoli, CPA CMA, your finance coach. My channel is all about teaching people how to save money, how to invest money, and how to think about money. I think anybody can take control of their finances. Anybody can reach financial freedom within a reasonable time. All you need to do is to learn a few basic concepts and apply them. You don't need to be a math whiz. You don't need to have a finance degree. You just need to learn a few things and apply them. And that's what my channel is all about. If this is the kind of thing that interests you, sign up, hit the bell button, and you'll be notified whenever I upload new content. So today's topic is when and how to sell your investments. So I'm going to break it down for you, make it simple. The first thing you need to do is to identify in your portfolio investments that are risky and speculative and the ones that are lower risk and more long-term. And an easy way to do that is if a company doesn't have any earnings or has a short history of earnings, an investment in a company like that is higher risk because the company doesn't have a track record. All portfolios should be made up of a mix of longer term investments and more risky speculative investments. The higher your tolerance for risk, the higher the content of the risky speculative portion. You shouldn't have more than 10%, 5-10% in risky speculative investments. And the way I like to label these investments, the lower risk, longer term investments are what I call the pillar investments. These are the ones that hold up your portfolio. They're pillars and they're solid and they're there for the long run. And the speculative risky investments, these investments I call play money. Why play money? You should be able to afford and be ready to lose this money. As a general rule, what I recommend is you should hold your pillar investments for the long run. But maybe you're not happy with your pillar stocks. Maybe your portfolio needs a checkup. One sell strategy is you want to reduce risk for the same return. Let me explain. So say you're holding some Royal Bank shares and you're realizing that you could reduce your risk by getting into a Canadian bank ETF like ZWB. This is one of my favorite ETFs. By buying into ZWB, which is a Canadian ETF, you are pretty much getting the same or similar return than owning Royal Bank, but with lower risk, because when you're getting into a Canadian bank ETF, you're owning a fraction of all the major Canadian banks. So this way you reduce company-specific risk significantly. Say something happens to Royal Bank, there's some bad news, there's a scandal, the share price goes down. Well, if you own Royal Bank, you're going to be directly impacted. But if you're into a Canadian bank ETF like ZWB, you're not going to feel that impact as much because you're more diversified. Another strategy is increase your return for the same or less risk. And that's just trying to select better products. So say you bought a mutual fund and you're disappointed because the costs are high and they're eating into your returns, and you spotted an interesting ETF that is pretty much the same risk level and has a decent return, similar return, but the costs are way lower because it's an ETF and has lower management fees. A strategy would be to sell the mutual fund and buy this ETF. So you're basically replacing a mediocre investment with better quality investments. Another opportunity to sell a pillar stock is when there's a significant market correction like we saw in the beginning of 2020. I don't need to explain why there was a correction, but it was significant and the markets hit real bottoms. Sky felt like it was falling. If you have money, if you have investments that are in taxable accounts, what you could do is do swap kind of maneuver. Say you own a Royal Bank. The strategy would be to sell your Royal Bank and buy another bank like BMO. So you trigger that tax loss. An even better strategy is to sell your Royal Bank, trigger that loss, and then buy a Canadian bank ETF. Double advantage, because number one, you're triggering that loss, and number two, you're replacing a single stock investment with a more diversified investment and similar returns. So that's a beautiful maneuver in those market corrections. So if you do have a single stock investments, as a general rule, I would recommend take a look at those and see if you can replace those stocks with some ETFs. I have other videos on that. I'm going to flash them up here. So there's my lazy portfolio strategy. There's also different ETFs that I recommend. So take a look at those videos. Okay, now for risky, more speculative investments. How and when do you sell those? Here's what I recommend, and it's always been a win-win for me. If you've done well and you want to bank some profits, what you can do is sell, but keep some of the profits invested. And here's the beauty of it, because it's always a win-win. If the stock tanks, you're like, wow, thank God I sold most of it. If it runs up, you're like, wow, thank God I kept a little bit. Now here's the situation: is the market has a huge correction and your speculative risky investments are affected, I wouldn't go out and sell. I mean, that's market driven and it's just momentum. That's a wrong time to sell. I also wanted to talk to you about what accounts to use for what kind of investments. In general, the lower risk should be in your RRSP, and the more aggressive, risky kind of investment should be in your TFSA or non-registered accounts. The reason being, if one of them starts to fly, Tesla, for example, if you bought some in 2015 and you made, I don't know, 1,000% on it, you rather have that investment in your TFSA or non-registered account, because if it's in your RRSP, you're going to be taxed when you take that money out, okay? And it's taxed at the highest rate. I have videos on choosing the type of accounts or the type of investments. Take a look at those. I'm going to flash them here. And one strategy you might want to look at is mirroring your risky investments between your TFSA and your non-registered accounts. And here's why. So let's say you have $1,000, you want to buy $1,000 worth of a risky investment. What you could do is put $500 in your TFSA and that investment, $500 in your non-registered account. And if the stock lies and you want to bank some profits, well, you can sell that in your TFSA and pay no taxes, because your TFSA is tax sheltered. Now, let's say the opposite happens and you buy an investment, but it tanks and you want to sell it, trigger losses. Well, you'll trigger those losses in your non-registered accounts, because you can carry that loss and offset it against future capital gains or past capital gain. Now, another strategy, and this is for more advanced investors, what you could do is, instead of selling, triggering all kinds of capital gains, what you could do is just buy put options. And put options are a right to sell a stock at a certain price. Most funds use put options to insure their portfolio. So if ever there is a mass correction, those put options are exercised. It offsets some of the paper losses of your portfolio. The put option strategy is for only advanced investors, and I will have a video on options, so sign up to my channel, hit the bell button, you'll be notified whenever I upload new videos on this, so stay tuned for that. Guys, if you have any questions or comments, leave them in the comment area of the video. There's a link in the description of the video, and you can book a one-on-one with me in my calendar. We can go through your portfolio, take advantage of it, because it's free for limited time only. If you like this video, smash the like button, and if you think the video could be useful for a friend, a family member, an acquaintance, please share. Folks, thanks for watching today, and we'll see you real soon.